Hi everybody, this is Darren Chu here. I have added a US ETF and also a Singapore REIT into my portfolio since the last update. So today I'm going to share with you why I add in this US ETF and the REITs into my portfolio. Before we talk about this, let's look at my portfolio as of 30 June. It has been running for 30 months, and these are the current holding I'm having. Currently, I have 11 US counter and 11 Singapore counter. Since my last update 3 months ago, I have added in Frasers Centrepoint and also TLT ETF, which is an iShare 20 years Treasury Bond ETF. And also, I have also increased holding for CapitaLand Ascender REITs and Mapletree Pan Asia Commercial Trust during these 3-month periods. This is my current holding of the 11 Singapore stocks and REITs. And from here, you can see none of the counter have more than 4% weightage, as I tried to have it at up to 5%. So currently, the 11 counter comprise of 5 REITs and 6 stocks. It constitutes about 30.35% of the total portfolio. As for the US sector, I have added in TLT, which is considered under a fixed income. And the other one is all 10 stocks. And the total holding take up about 33.36% of the portfolio. On top of that, I still have a cash balance of 36.29% to further invest. This is a performance of the stock portfolio against my capital since I started in January 2022. And from this chart, you can see that this portfolio has been constantly staying in profits since October last year. As this portfolio focus is mainly on income followed by growth, you can see that the dividend collected have been steadily increased over time. As of the starting of the portfolio to now, I've collected more than $2,000 in dividends, and this dividend trend will continue to increase. I think most of you will know that when we buy US stocks, there is a 30% withholding tax we need to pay when we collect the dividends. But however, there are certain stocks that will have a portion of the tax refund given to us. For example, I have this reality income, which is a REIT, and in May, actually, I have getting a tax refund back for the tax they have charged me for the year 2023. So these are the total tax refund I have collected back. When you compare this with the actual dividend here, the tax refund is not really a lot. This is the dividend they pay me where it is subjected to 30% withholding tax of $3. That's for the dividend payout in the X date on November 2023. So the tax refund they give back me is another 21 cents. So actually they refund me maybe another 2 to 3% back of the dividend. So the total withholding tax for reality income is not 30%, it's around 27 to 28%. But for stocks, why there is no tax refunds? For stocks, the full 30% withholding tax will not be payable back to me. Now let's look at the new ETF I have added in, which is called TLT, that's the ticker code, and it's an iShare 20 plus year Treasury Bond ETF. Why I add this into my portfolio? For my portfolio, I'm mainly focused on stocks and REITs. So there's an asset class that is missing, which is called a fixed income asset class. And we know that as interest rate cut may happen any point of time from now onwards, and when interest rate cut, usually the bond price will go up and there will be a potential capital appreciation for bonds. And thus, I decided to add in TLT into the portfolio where I found that the price is really attractive at this juncture. For those that are not aware what is TLT, TLT is an ETF that invests in US Treasury bonds that is 20 years and above. It's just like you're buying Singapore government bonds. So this is buying US government bond. And this ETF only buy US government bond that is 20 years and above. And currently, you can see from the fact sheet is currently you have 44 holdings. That means you have 44 US government bonds that mature at different time periods, but usually will be 20 years and above. And this is the performance of it. From here, you can see that the fund have a very low expense ratio of 0.15, and it have an effective duration of 16.45. What does effective duration actually means for bonds. If the interest rate were to cut by 1%, there is a potential for the bonds to increase by 16.45% in price. So that is what the effective duration actually means. Means a 1% cut in interest rate will result in a bond price go up by 16.45%. But do take note, this is an assumption. The actual performance may differ. And also this talk about a particular bond, but not an ETF per se. Doesn't mean that if the interest rate cut 1%, TLT will go up by 16.45%. I'll explain further why it may not happen, but I feel that there will be upside potential. It's just that we don't know how much it will go. And another misconception a lot of people have is about bond ETF. They always thought that bond is safe, especially by buying US Treasury bonds. So it will be relatively safe if you are able to hold to maturity. Yes, that's provided you buy a single bond. But for TLT, because it's an ETF, it is volatile and is subjected to market swing. And we look at the standard deviation for TLT is 16.66%. 16.66%, what does it mean? It means that the share price will up 16.66% and down 16.66% 2/3 of the time. So this standard deviation is as good as a standard deviation of Singapore stocks and REITs. So it is not a low risk ETF. That's something you need to take note of because of the higher volatility. If you're looking for something that is low risk, then you should look for a standard deviation at a low single digit. That will be on the lower risk side. These are all the holdings of TLT as of 12th of July. So from here, you can see the maturity dates of all the bonds that they hold. Majority of them will mature more than 20 years later. And for those that have less than 20 years to go, you can see that the weightage is almost zero. This ETF, the mandate, you have to buy ETF that is 20 years and above. So as every year progress, this ETF may need to sell off those ETF they have bought previously that now have less than 20 years durations. So they need to sell it off. Then they need to buy a new ETF that is more than 20 years. And thus, actually, it is subjected to price fluctuation as the ETF they bought maybe 5 years ago, now it's less than 20 years, they need to sell it off. The price may actually dip and they may need to sell it at a loss. And this is why the standard deviation for TLT is so high, as we know that when the longer duration a bond is, they are more sensitive to interest rate fluctuation. The volatility will be higher on that. So that is a risk that you need to be aware when you want to buy a TLT ETF, a long duration bond ETF. But of course, the potential capital gain will also be higher compared to those short duration bonds. This is the performance of TLT gathered from their website as of 30th of June. We have seen that over the past 3 years, TLT actually have suffered double-digit loss. Why is that so? Because of interest rate rising and thus the price have been dropping. Although they have paid dividends, so this is a total return that include the dividend you collected. Actually, you still suffer losses. And we look at the cumulative total return. However, over the years, if you buy TLT, TLT is launched in 2002, it's more than 20 years, and if you hold for 20 years, you will make about 100% total returns. But if you buy TLT 3 years ago, you actually now suffer a total 30% loss, which is 2022, where the interest rate have started to increase sharply. And we can see that this TLT have actually suffered a 31% loss. So this is just a reminder that bond ETF, fixed income ETF, even they buy US Treasury bond, doesn't mean they are safe investment. Doesn't mean they are low risk investment because they are ETF. They are not individual bonds. And the fund manager will need to sell off the ETF that is less than 20 years. The selling price was subject to market price. And why I decided to buy TLT ETF at this juncture, I look at the historical NAV over the past 5 years. TLT have been hover around here, and it's actually is at a 5-year low price because of interest rate have been creeping up and TLT have been coming down. And if I look further at a 10-year chart, it is also at around a 10-year low price on their NAV. And with the expectation of interest rate going to cut, so the potential upside for TLT will be there. And on top of that, while waiting for interest rate cut, I'm being paid dividends every month. This TLT is paying dividend on a monthly basis, and currently the analyzed yield is more than 3%. As I mentioned, that you will buy a US stocks, if they were to pay you dividend, you are subjected to 30% withholding tax. But for TLT ETF, for US Treasury bond related ETF, there is no withholding tax. Whatever they announce they will pay out, you will get 100% of it. Compared to if I to buy another stocks that also pay me 3% dividend yield, but this 3% is subjected to a 30% withholding tax. So the net dividend yield to me is about 2.1%. But for TLT, if it is a 3%, I'll get the full 3%. And the next counter that I've added on is a Singapore REITs. It is Frasers Centrepoint. This will be a non-strainer to many REITs investors. It is one of the best performing REITs in Singapore. And what they are mainly focusing on, they are mainly retail mall, and their retail mall are suburban retail mall. That means they do not have any shopping mall in the downtown area or along Orchard Road stretch. You will not find Frasers Centrepoint. They are mainly in a suburban mall. And you see, so suburban mall, they are more resilient compared to a downtown mall. And the mall are located near or next to an MRT station. And this is why there is a very large catchment area for this shopping mall. We have a combined 3 million catchment population for this shopping mall. And these are the 9 suburban malls that Frasers Centrepoint currently hold. The latest one add into them is called Next, where currently they have a 50% effective interest. And I will believe over time they will increase the interest. And same thing, Waterway Point, they currently also have a 50% interest. So this is what I look at potential growth, where when we look at the risk, we also want to look at whether do they have any growth potential. Were they able to acquire more malls or able to increase the holding? And this make them the potential Waterway Point. And next we got this North Point City North Wing. Beside North Point City North Wing, there is still a North Point City South Wing. That's still under their sponsor. And this is also a potential for the REITs to acquire. So at least in the next 3 to 5 years, there is a potential growth for the REITs. And on top of that, this REIT currently is the largest suburban mall landlord. It currently holds 9.2%. It is even bigger than one of the Singapore biggest REITs, CICT, CapitaLand Integrated Commercial Trust. Although CICT is much bigger than Frasers Centrepoint, but in terms of suburban mall, CICT only comprises of 8.7%, and Frasers Centrepoint is the largest suburban landlord in Singapore. At this current market conditions, where interest rate is very high, their financial position is still very strong, where they have a very healthy gearing of 38.5%, and their adjusted ICR is 3.26%. To me, it's a very good ICR where many REITs are suffering due to high interest rate. And some of the REITs ICR even fall below the MAS guideline of 2.5 times. And this REIT is still able to maintain the ICR above 3% at this current market juncture, which I think it is very commendable. Okay, next we look at the dividend trend. Pre-COVID, this REIT is one of the few Singapore REITs that never dropped their dividends since IPO. From this slide, you can see that dividend have been increasing steadily every year in, year out since their IPO in 2006 until COVID happened. At the point of time, they have a drastic cut in dividend, but that one is understandable where we are on circuit breaker. We can't even go out as per normal, and touch shopping mall don't really have sale. Actually, when I go to a shopping mall, it's just like a dead mall. There's no people, no traffic. That is understandable that their dividend have to come because a lot of tenant is suffering. But after the COVID is over, their dividend have bounced back up, although it is still hover around 12 plus, but do take note, it is still higher than the pre-COVID level, where some of the REITs have not even able to recover their dividends, and this REIT able to recover their dividends to be higher than the pre-COVID levels. And the current dividend yield for this REIT is more than 5%, which is to me is a very reasonable dividend yield for REITs at this market juncture. And let's look at the price performance of this REIT since IPO. If you to invest this REIT since IPO, your total will make about 200% returns. What does that mean? Means that your capital will double. If you were to invest 10,000 inside this REIT, now market value will be 20,000. And this is excluding the dividend you have collected since IPO. If you were to add in the dividend you collected, it is 564%. What does that mean? It means that the dividend you collected is already more than the capital you invested since IPO. So whatever price in the market now is actually pure 100% profits. Why I decided to add this Frasers Centrepoint into my current portfolio is this is the 4 REITs holding that I actually have. I have Ascenders, Maple 306, but both are industrial REITs. And I have Parkway Life is a healthcare REIT. I have a diversified REIT, which is Maple 3 Pan Asia Commercial Trust. We have office buildings and also shopping mall, but the shopping mall they have in Singapore is only VivoCity. And thus, I add in a retail mall into my portfolio at this market juncture where I find the opportunity to add in. And thus, I decided to add in Frasers Centrepoint to fill up the gap of my risk portfolio where it's lacking of shopping mall that is in Singapore. And some of you may ask why I didn't add in CICT, which is CapitaLand Integrated Commercial Trust, which also have a high Singapore presence. But why I decided to do that is because CICT currently is a REIT that comprised of office buildings and shopping malls. But at this market juncture, I prefer to just focus on shopping malls. Both are equally good REITs and both are two REITs that I want to add on to my portfolio. But at this market juncture, I look at the price and I also look at the current market condition. I will prefer to add in a more defensive REITs, which only mainly comprising of shopping mall in the suburban area, which is why I add in Frasers Centrepoint over CICT. Now look at my unit trust portfolio, which currently comprised of 8 counter. The main changes you can see from this on the previous update is that I have decided to switch my Philip Money Market Fund to Nikko AM Short-Term Bond Fund, as if the interest rate were to drop, money market fund return will also drop. Thus, I prefer to go into a short-term bond fund, as we know that when interest rate were to drop, the interest payment for bonds will drop, but however, there is a potential capital upside. Although short-term bond, the sensitivity to interest rate is lower, but long-term performance-wise, if I'm looking at the interest rate cut environment in the futures, then I'll prefer to buy a short-term bond over a money market fund. And this is why I decided to switch to a Nikko AM short-term bond fund from the money market fund. So that is the main changes I have done for my unit trust over the past 3 months. And this is my unit trust performance. Initially, the unit trust performance was negative for many years. And one of the key reasons is there is China exposures and there's a lot of Asia exposure which have really dragged the portfolio down. And after I made a switch sometime in October last year, where I completely removed China fund from the portfolio and more focus on global and US market, and this portfolio has started to turn positive, and now you can see that the gap have been increasing, and in fact the year-to-date return for this portfolio is double digit. That's all I have to share with you today on my portfolio updates. And do take note, whatever counter I mentioned here is just for your reference only. It doesn't constitute any recommendation to buy or sell. Do remember to do your own due diligence on that. And if you find that this video benefit you, do remember to like, share, and also leave your comment below to let me know what you think. I shall see you in my next video. Bye bye.